Hello everybody, welcome to this week's edition of Northwest Quadrant Wealth Management E-News. Thanks for joining us. Hope all of you are having a great summer and staying cool. So today we thought we'd talk about the inflation data we've got and what the Fed is most likely to do at their next meeting. And then Josh can talk about investor behavior and the psychology around markets and what the commonality of our successful clients are versus what has led to their good returns versus some of our clients that maybe have less than stellar returns because of their behavior. So we got both the CPI, so the inflation at the consumer level for the month of June, and inflation at the wholesale level, the PPI number last week. And both of those came in lower than expected. So year over year at the consumer level, inflation in the month of June was 3%, which was lower than expected. And at the producer level, it's 2.6%. Both of those were better than expected. And so one thing we can't deny is that inflation is headed in the right direction for the Federal Reserve. But the Federal Reserve also paraded out a bunch of their talking heads, their Fed governors from around the different banks in the rest of the country. And what's clear is that they're still hawkish, that the Fed still believes that they have more work to do because they really want to make sure inflation is out. Sort of like when you put your campfire out, you really need to make sure that it's out. Smokey the Bear wants you to make sure it's out. And I think that's what the Federal Reserve is doing with inflation, because they know if they pause or indicate that they're going to pause for a long period of time or even cut rates, then inflation will come roaring back, and that's one of their big concerns. And so their next meeting is July 24th and 25th, so in about a week and a half, and most likely they'll raise interest rates by another quarter point. And so, we think that's probably the right thing for them to do, because inflation, if it does come roaring back, could be quite painful. And so, market probably has priced that in. I don't think it'll be a surprise. Now, if the Fed raised rates more than 25 basis points, that would be a surprise to market. But we did get the inflation rate moving certainly in the right direction. And so Josh can talk about the behavioral attitude that is happening when markets are either really bad or really good, which we've seen both of in the last 12 months.
You'll certainly never find us complaining about higher stock prices. But it's important to remember, I think, that things they're never as good as they seem, and they're never as bad as they seem. And we're just over halfway through the year now. 3.5 months ago was definitely one of those low ebbs in sentiment during the midst of the banking crisis. Rewind a little bit more back to those September, October lows in the market, where we found we were down almost 27% off the highs in the S&P. Rewind a bit further from that, and we were at those June lows back in 2022. So, it's really 3 low ebbs in sentiment. Never was the situation as bad as many people out there perceived it to be. Similarly, it's probably not as good as people perceive it to be now. There's still a lot of risks, and we're not going to find any clarity about the outcome of this situation anytime soon, and I think that's pretty hard for people to deal with. But remember, the important commonality for all of the best investors amongst our clients and professional investors across the world really is that they maintain an even keel and an even temperament through both the good and the bad times. And that's something that we're all well served to remember when we sort of get gripped amidst this euphoria of ever increasing stock prices. And we're sort of, we notice more than ever anymore that sentiment shifts go from fear to greed more quickly than I think they ever have in the history of markets. And part of that is maybe a result of just how diffuse information is now, and how the 24/7 news cycle feeds into, creates these feedback loops. And it's not as good as it may seem right now. There's definitely a lot of headwinds, and it's always the unknown unknowns that are going to ultimately represent the biggest problem for markets. And so it's never the truck that you see that hits you and kills you. So keep that in mind as we enter the rest of the summer.
Remember, like Josh said, things aren't usually as bad as you perceive them to be when markets are down. And just right now, as markets have had a banner first half of the year, they're not as good as you probably are perceiving them. We get lots of calls last June and last October from those of you that think the sky is falling. We don't hear from you when markets are up as much as they are now. And so, like Josh said, the key to our most successful clients is they never let the bad markets throw them for a loop, but they also never want to take more risk when markets are good. They just keep that even keel, and they only let their life circumstances dictate us making changes to their accounts, not the markets. Those of you that want to make changes based on the markets are the ones that have lower investment returns than our clients that only let their life circumstances dictate when we make changes.
You'd be astonished how quickly our phones go dead when the S&P's up 6 straight days.
Yeah, so as always, it's all about temperament. Most of the successful investors, whether it's Buffett or even our most successful investors, have the ability to remain calm when others are losing their head. So as always, if you want to talk about your situation or your account, you can call the office 800-743-0988 or send either one of us an email, Josh or Tyler at northwestquadrantwealth.com. We'll see you back here in 2 weeks.